and there they specify that we need to follow net realizable value, but at the same time one definition borrowed from there, and when we go there they say that we do not, it is not covered. So there is, do you find some, unsound reasoning, some fallacy? There is some fallacy. So we need to understand the exact difference between what is fair value, what is your net realizable value. Just Index 2 para 7. Okay. Is it, you can see from back? Visible?
Yes, yes.
Okay. Audible also?
Yes.
Okay. Just go through this.
7.
Yes, pass.
This is para 7, Index 2. The former is an entity specific value semicolon, the latter is not. So latter is what? By what name we should call it? Fair value. No, it is not entity specific. Then this is what? This is market based measurement. This is market based measurement. So we need to understand, because the standards specifically make a distinction between net realizable value and fair value. Just para 8. Sam. Not coming.
Once you are done,
If you have incurred some cost to fulfill a contract, that is not your inventory. Peculiar thing is, when Index came for the first time, they asked us to follow 115, revenue from contract with customers. Okay? Now, there was tremendous hue and cry throughout the world. Then they deferred the date. They made applicable from 1st January 18. This January after this one. So we also deferred and we brought back again this old 18 and 11. Okay. So anything that you spend on a contract that is not inventory, that is called contract asset. So you keep on spending money on a contract, everything is transferred to contract asset. And if you get some money, that is credited to contract liability. I have received money, cash debit to contract liability, I am spending money on that. That is my contract asset debit to cash and other assets. Now, net realizable value and fair value, just see the first example. In the handout, see the first example. I hope things will be clear. You have the handout here, suppose, all of you?
I did not get it. Well, you did? Yes. I'll go down.
Okay? Sugar mills, what percentage is given to the government? Much below the manufacturing cost? 20. 70%. Imagine. 30% is free sales. 100% politically controlled. Also that 30%, 100 you cannot sell on your own. Sugar price they will fix. Area is fixed. You cannot buy from anywhere. So one thing I sell at fair value. Sabu, is it clear what is the difference of fair value or net present value? Very good. Next.
No, but one thing is not clear.
Which one?
At what value will the inventory be valued? Because fair value, 70%.
Inventory's value is much lower than the cost you have to sell. That's the value. Your manufacturing cost is 40 rupees per kg. Government will take you from hardly up to 20 rupees.
No.
That's the fair value.
70% is valued at net realizable
Yes.
value and 30% is the market value. So what will be the value of the inventory? Be valued accordingly.
Yes, so division like this. Achha, this is the main thing you know, that inventory is expensed, matching concept. So I buy inventory, either it's an asset or it is matched with my revenue. That is the actual basis matching concept. And it is become our cost of goods sold or cost of sales, as the case may be, and inventory will, value will go down because this become an expense. So inventory when can be matched only against revenue, and revenue can be in the form of cash or in the form of receivables. This I'll be explained just after some time. Next. They say that how do you classify? This para 8 I could not show you. As you know well that inventory can be of three types. That is raw material, work in progress and finished goods. Work in progress arises because of accounting periodicity concept. I started something, wanted to complete those, but my year ends, so I stop there. So that is partly finished production. This you know very well. Next. They are measured at LCM rule, and group of similar items are taken together. There is one thing you will see in India's one, that is called materiality and aggregation. So similar items are taken at one place, just like our block of assets. Similar items, block is a group. What is a group? Group is a combination of similar things. And combination of dissimilar things, what is called? That is called composite. We are taught mean, median, mode. You find out composite mean. They never say group mean, because mean itself is group mean. So when there are similar inventories, they put at one place, and if they are different, then they are classified. Because FIFO, LIFO, the moment you calculate, we take into consideration everything at the same. They acquired at different rates, but they all look alike. Next. Inventories are cost of purchase plus cost of conversion when we convert this, and overheads we always a percentage, because overheads we don't know beforehand what will be the total overhead and how we allocate. So total cost is material that we know, raw material, plus labor that we have spent, and a percentage of overhead. It can be under absorbed, over absorbed. I am coming to that next. Next one. Same rule for a service provider. This is nothing new with the old one. Okay? Next. This is very, very important. Overheads are anticipated, we keep on charging, that is called absorption of overhead. So amount overhead estimated and actual amount charged has to be two different things. They cannot be the same. Take a very simple example. In a college canteen, the manager, he knows that I have only one overhead. That is what? I need to pay to the rent to the college 1,000 rupees a month. That is my only overhead. I have to pay to the college 1,000 rupees rent. College has nothing to do that what I recover or what I charge from. Now, the canteen manager expects, rather anticipates, that I will be selling 1,000 cups of tea in this month. So keeps on charging how much? 1 rupee per cup. Okay. Now he end up selling 800 cups at the end of the month. So 200 rupees is what? That is the under absorbed overhead? Yes or no? Yes. Straight to PL. No carry forward. What is written there, you see? It can be over absorbed also. I estimated that I will be selling 800 cups of tea. I keep on charging 125. I have sold 1,000 cups, so I have charged much more. It's all right then, it's no problem. But under absorbed overhead are never carried forward. It is straight or written off to PL. Please see example 2. Handout. There is no impairment of inventories. There is no question. Because at the end of each year you value your this. Impairment is only for other artists, that when there is an indication of impairment, only you go for impairment. And that is based on two things: your recoverable amount, that is the higher of fair value cost to sales, and how much cash it will generate. That is called value in use. So there is no question of impairment of inventories.
Can the entity say that, okay, last year my normal level of production was 1,000 units, this year my normal level of production itself is 960 units?
No problem. You keep on charging. Overhead is always an estimate.
Yeah. In that case,
Overhead is always an estimate.
in that case I will not have
Fixed
to take-
overheads you know, variable overhead don't know. Okay? So you keep on charging. Any balance if you have, for that you have to pay money to an outsider. It's written off to PL, no carry forward. You are keeping on charging 1 rupee per unit, suppose, okay? You have produced 800 units, 600 sold, 200 remaining. Remaining 200 balance what you have, that is written off to PL. Please tell me if I can go ahead, because there are so many things I need to tell you. Can I go ahead, please? Oh, thank you, thank you. Next. There is a separate standard you know very well. In rare circumstances, borrowing costs are included in inventories. Accretion process, what do I manufacture? Scotch whiskey. So regular flow of inventory, same thing, regularly happening, buying and selling and everything. So it has to be, very well, it has to be a qualifying asset. Now, if borrowing cost is charged to inventory, I borrowed money, okay, to make one qualifying asset, that is inventory. What I manufacture, it will take, say, 3 years or 4 years to complete. Okay? Say very simple example I have taken, that 20 rupees I have paid for interest, and that is not written off to PL, it is added with the inventory. Okay? So this transaction, does it affect my accounting profit or taxable profit or both by the same amount, or it does not affect at all any profit? Out of the 4 alternatives, it affects my accounting profit, yes or no. It affects my taxable profit, yes or no. It affects both my accounting profit and taxable profit, but by a different amount. And last possibility is, it does not affect any of these two. Which one is correct?
It affects both accounting and taxable profit.
Yes?
Affect both accounting and taxable profit.
It both affects accounting and taxable profit. Anybody?
Taxable profit.
It affects taxable profit only, does not affect accounting profit. Yes, ma'am? I can see your hand just indicating something. I can make out from here. Both. Anybody else?
Accounting profit only.
Yes?
Accounting profit only.
Accounting profit only. Pass the journal entries. Chalo. I understand only journal entry, nothing else. If my journal is correct, sir, sab kuch correct hai. Borrowing cost debit to cash. There are two possibilities. PL debit to borrowing cost, inventory debit to borrowing cost. What I have done?
Interest debit to stock.
Inventory debit to?
Inventory.
Inventory debit to borrowing cost. So ultimately what? Inventory debit to cash. The resultant entry, yes or no? Cash is reduced, inventory balance is increased, yes or no? No effect in my PL, so it does not affect my accounting profit. But I can avail of what? Tax deduction. Yes or no?
Yes.
So how does it affect? It will be a deferred tax liability or asset. चलो तुम्हारा income tax घुस गया.
Deferred tax liability.
Deferred tax
Liability.
liability. Yes. Can I use the board here?
Yes.
Year 1, if you are charging interest to the PL account, then the year 1 it will be.
I am not charging to PL. It is deductible from income tax purposes.
Had it been charged to PL, then it
Then there is no deferred tax nothing. Because what I have charged, what is allowed are two same things.
Yeah, you are telling that if the interest is capitalized with this
Stock, inventory. If it is added with the inventory,
Huh?
profit will change.
Profit is unaffected.
Profit of that year will change. Maybe subsequently it will.
No, profit is unaffected.
It takes 3 to 4 years to make the investment.
This year, if I have paid interest and it is entirely charged to revenue, how does it affect my profit?
But if you charge inventory,
Huh?
if you charge to inventory, then
Huh?
inventory value will increase,
Yes.
and then the interest will be debited.
My inventory value is increased and my cash is decreased. Same thing.
No, but interest will be debited less in the profit and
Huh?
loss. Interest will be debited less.
Interest? No, I am not debiting at all. I am charging to that inventory. It's a qualifying asset.
What your question was, interest you will take the debit to profit loss account, or if you
No, I am not debiting in PL. Interest I have paid. Interest on borrowed capital. Interest debit to cash. Inventory debit to interest. PL is unaffected. But tax I can avail of. So there will be what you said is? What will be? you see all of you?
Light is affecting.
Huh?
Light is.
Can you see all of you? Huh? Suppose my accounting profit 100. Okay? I have not charged interest in my PL. Debited to where? Inventory. So my tax expense has to be 40 on actual basis, yes or no? 40% tax rate?
That inventory is considered while arriving at your accounting profit. Change in inventory is considered. It is coming in the profit and loss account.
No, inventory at the end when I revalue inventory, that will affect profit. Otherwise, why it should affect profit?
No. What you are telling that part say,
Huh.
this borrowing cost is added to inventory.
Huh?
Then inventory value is increased
Huh?
to that extent.
Huh?
And that inventory value
Huh.
is part of your profit and loss or trading, whatever name you call it.
Huh.
It is part of
But
that.
that is not matched with my revenue. Imagine this.
No, that is increasing your profit.
No,
Why, sir?
it is no.
If we just debit the inventory, the value of
It is
inventory
not.
will increase.
How can it increase my profit? Cost of inventory is increasing. I am not matching that. Inventory that is eliminated unsold stock from my profit.
Things stock is coming as an element in your profit.
This inventory value will be adjusted the moment I sell this along with this one.
Not getting, sir.
So 40 rupees is my
Cost of
tax expense. It's the aggregate of two things. What are those two? Current tax and deferred tax. What is the current tax? Current tax
24.
yes. Balance is what is this? Deferred tax expense liability. Next year same 100. Tax expense is why 40? Next year the 20 rupees is deducted.
Sir, can you
This inventory is consumed.
Can you explain that 32? How the
100 minus 20 interest I have paid.
Okay.
32 balance is same. Next year that inventory is consumed. Inventory is debited more by 20 rupees. What is not charged here? Next year it is consumed. So how much it is coming? 80. Actual basis has to be how much? 32. Tax paid how much this year? Current tax how much? 40. Less deferred tax liability.
Against 100, that 40 is fine.
So inventory, when I do the thing, it is increasing my just buy one inventory. It cannot reduce my profit. I buy inventory, I pay interest for inventory. Thing is the same. Unsold stock is eliminated from the accounts. एक बात देखिए, small things I tell you. You have purchased 100 rupees, 1 rupees, 100. You bought 100 rupees, 1 rupee per unit is the purchase price. Total cost is how much? 100. 50 units you have sold for 150 paise. What is the sale? 75. कितना बचा? 50. ठीक है? Destroyed by fire with no recoverable value. What is my profit? Remaining 50 units for the time being. I'm not really sure. কষ্ট করতে হয় উপর নিচে করো না বলবে স্যার ভুলভাল পড়েছে চাকরি চলে যাবে বুড়ো বয়সে আই লুজ মাই জব স্যার টেল মি 50 units remaining destroyed by fire with no recoverable amount. How much is my profit or loss?
Loss of 25.
Is the question clear, sir? Remaining 50 units destroyed by fire with no recoverable value. What is my profit and loss for the period?
25 loss.
I have earned a profit of 25. I have earned a profit of 25. But actually I have suffered a loss of 25. My trading profit is 25. Had there been no loss, I would write closing stock on the other side. I would write closing stock 50, it would have been 25 rupees. So my trading profit is 25. So regarding borrowing cost, whenever you do, there is a one separate standard for this. Borrowing cost application on inventory is a rare occasion. I need to cover all the paragraphs of the standard, that's why I am sharing with you. It will be mainly for the qualifying assets. It is only for some acquisition process, one thing takes 4 to 5 years to manufacture. For regular inventory, buying and selling, tremendous input outflow, borrowing cost won't apply.
In the case of liquor,
So para 17 is please. Huh?
sir, in the case of liquor industry,
Ah.
charge,
Hmm?
the interest is added to the inventory. And in the case of rice also,
Ah.
if it has got to be kept for longer period, the interest is to get added.
Yes. That has to be a qualified asset. I gave you the example of that only. Na? So para 17.
In case, sir,
Ah, please.
in case land is acquired for the purpose of construction,
Ah.
and due to getting the, permission from the local authorities, it takes a couple of years.
Ah.
In the meantime, there is a borrowing cost which is attributable to the land and for the development of the property.
Mm-hmm.
In that case, what happens?
That case, it is covered by borrowing cost. That is a separate standard of this.
So will it be, will the
Apply there only. Yes.
inventory
Yes.
cost go up?
It's a tangible asset, so it is covered there only. So anything you spend on, actually the thing is, I don't know much about this old revenue and construction contract. The 115, peculiarly enough, you see the standard have not changed. They still put here 115 only. Achha, it's a paras. Why is he?
It's coming.
So, chalo. That is 17. 17. Limited circumstances, you see. They make it very special. For that there is different standard borrowing cost. It is very, very limited circumstances. Right. Next. Have a look at the para 18. I want to buy a refrigerator. I went to the shop. Okay. They say the price is 10,000 rupees. I said, no, I can't afford a refrigerator. He says, no problem. You pay 1,000 for 12 months, pay 12,000 rupees. So I pay and become very happy. Why do I become very happy? Because we have certain habits. We always believe in present consumption than future consumption. I am ready to pay 12,000 rupees, 2,000 extra, I pay how much? Interest. If you tell me, कि घर में जाओ, keep on saving 1,000 rupees, come after 10 months. I will give him one slap. Now, 2,000 rupees what I pay?
Interest cost.
Interest cost. Now the thing is, I tell you, if you go and buy one refrigerator, now suppose you don't go, okay? You send your spouse who is not an accountant. बोले देखो तो EMI में अगर होता है तो, now she telephones you, बोले हाँ, they are charging EMI with no interest cost. I am an accountant, I know what is what, I understand time value of money, IFRS is based on this. बोले no interest cost, बोले no sir, we don't charge any interest. And yes, what is the price? Well, the price is 10,000 rupees, you pay 4,000, that you will have to pay in either way, and balance 6,000, you pay 1,000 rupees per month for 6,000, so you don't charge any interest. My wife becomes very happy, but that's sure, no interest dichche na. And I said 10,000 rupees to cash down for how much you will charge, tell me. But I said give me 9,000 rupees. So anytime you see, somebody told me, sir, that managing director of that company is a very close friend of yours. I am a manufacturer of this, whose company which is बहुत लगता है. Can you such arrange? हमरा देखो भाई, I can arrange, I can introduce you. लेकिन बीच में तुम क्या होगा नहीं होगा, I do not know. क्या terms of payment वो सब नहीं है. I will take you introduce there. Okay? ठीक है? So I told MD कि देख बेटा क्या किया जाए. Well, sir, just talk to my purchase manager. हमरा देखो भाई, if it is favorable, there is no favor to nothing. You buy from other people also. One more. If you have 100, just one is added. No personal favor, but ठीक है sir. Now tell me, what you can supply? Well, I can supply this. Well, very good. But the thing is, you see, our payment term is 8 months, 240 days. Well, 8 months. But normal credit terms is in that market only 3 months only. Well, no, it is our 8 months. You see, normal credit terms. You see. Now the purchase manager bluntly said, you quote accordingly. ऐसा होता है कि नहीं sir? Huh? He bluntly said, you quote accordingly. Thing is, what you buy, a part of will be interest and part of will be inventory. Part will be affecting my profit and part will not affect my profit. Inventory debit, finance cost debit to cash. Either way, there will be two severe problems. I hope you know these two. You should know. I am not supposed to know. You should know this. There will be two severe problems. What are those two? For buyer and seller. I am not in practice. You are in practice. Please tell me. Previously, we used to buy. Told me quote accordingly. 10 rupees thing you quote for 13 rupees. Here 10 rupees thing you pay for 13. That means 10 rupees for the inventory, 3 rupees for the interest. Okay. There will be very, very severe problems in actual practice. What are those two? Yes, please.
Selling and purchase will not match.
Yes.
One person say,
वो बाद में initial problem क्या होगा? There will be tremendous problem on VAT and TDS. Yes or no? Yes or no, sir? I am telling from my theoretical knowledge.
Yeah, of course.
Huh?
Yeah,
There will be huge problem in this two. Absolutely new thing.
TDS is not there because it's purchase. It's a sale, so TDS is not there.
No, either party will definitely. It is interest charged.
Yeah, so. Oh.
It is interest charge. Imagine you are buying something for 5 lakh rupees. You are paying 4 lakh 50 for the material and 50,000 for the interest.
But in the invoice, the supplier is not going to show the two components.
Has to.
Supplier will not
You show or you don't show is different thing. What IFRS want to tell us that you will have to do this. Difference payment when you make simply. If you are not making the payment within the normal credit terms, that means you will have to pay more. Common sense, time, value of money. So if you pay more than this, that means it shows that your going concern already apply. Your other people are normal credit terms in the market 3 months and you are taking 8 months. That means you have certain liquidity problem, no doubt about this. You are not able to sell goods much above your manufacturing cost and are unable to collect your dues in time. So you show. So moment he shows that this is the amount of interest they have paid only on borrowing things. This thing you have to cover by selling it at a higher price. What you will do in actual different, what is the standard wants I tell you. Pure faithful representation. I go back to conceptual framework. Acha, next. This is over, I suppose. Next. Where you use specific identification, most of them are fungible. They lose their identity when they get mixed up. Just like nowadays this is all electronics. Previously the share certificates also. They look all alike but acquire different prices. Inventory also today I buy for 5 rupees, next day 5 rupee 10 paise, third day. So we follow, you see this LIFO weighted average. So when do you follow specific identification? When we can identify that one can be car. Each and every car having one unique identity number. Refrigerator, so big things. There we apply specific identification. Now, this standard says that one more method apart from these 3 that is called retail method. There are 22. চলো আসবি খুব ভালো লোক অনেকে দেখে ভীষণ খেয়াল রাখে আমার মতো পাগলকে হ্যাঁ গান থ্রু হ্যাঁ গান থ্রু visible from the back.
Sir, can you increase the font size a little bit more?
Increase.
Increase the font size. So it is a
Enlarge. You.
Could you please explain it?
I don't explain, sir. I give you illustration. Lesson 5. Example 5 in your hand. Example 5, sir. Post-pattern retail method. Yes.
They're saying each retail department.
Hmm?
The last line saying each retail department.
Hmm.
In irrespective of the nature of the items.
See this example, you will.
Example is in grade A, B, C.
These three gates, this unit at I paid 90,000 rupees for the entire lot. I paid 9,000 for entire lot. Grade A there is 5,000, B.
There's a nature of item is same like the
Yes.
It may have grocery, it may have the present item.
I bought it at yes.
When we should have to find out the percentage margin for department.
Margin is the same. Three different grades I bought it for 90,000 rupees. I decide that I can sell it for 1 lakh. So my markup is 10%. You understand this markup? What is markup?
Cost plus profit.
So 10,000 you deduct from this. 54,000 cost.
How the standard cost method is applied?
Where? Inventory you can apply standard cost if it is close to your actual cost only then. But I have not come across the application of standard cost in any industry. Though they say that you can apply standard একটা কিছু আছে আগের দিনে হ্যাঁ নোটই স্ট্যান্ডার্ড নেই স্যার 100 rupee note financial asset, 500 rupee note no financial asset till 30th December. Abhi 50%. If you can give 100 rupee note, there is a chance you can get 9 100 rupee notes against 1,000. So I promise to pay the bearer. No, I do not promise to pay the bearer the sum of 1,000 rupees.
I promised to bear, provided it divides.
Okay, so standard cost I have not come across. If it is very close to your actual, then you can apply. They also say they recommend standard cost, but
These two methods are actually different from the ASP original.
I don't know. I have forgotten.
One thing how every product can have.
Sir, वो करते जावे बोल रही थी. One thing I tell you, the same thing everywhere I see. उसका एक effect भी आ गया ना. One there is a very bad effect of that. Everybody wants speaker to say what was there, what is this. So there has one thing has become one common sense wisdom that if I know the difference, then I know the accounting standards. If I know the difference between IS and Ind AS, then I know Ind AS. There is a chalk and cheese difference. Forget to the extent possible. Read this just paragraph. You will have to mention this paragraph only.
For better understanding, it is required, sir.
No, sir, you go through in this paragraph. You go through yourself.
Management will want to know what would have been the profit under the earlier standard.
But I can't help you in that respect.
No, we have to give reconciliation. Profit as per the for previous period, the profit as per years, and now
Management will ask you what was there in AS1 and what is there in Ind AS 1. What you will say? Just tell me. Sitting at the top, being a non-accountant, might ask many questions. What you will say? AS1, disclosure of accounting policies. Ind AS 1, presentation of financial statements. Everything is there. Whole Ind AS is included there. How to value inventory? There in Ind AS 2 also there. Cash and cash equivalent, what is the value there? What is the value meaning here? Everything. How will you explain that? Next. Retail method is yes. Do you remember 3 things? Physically possible, legally permissible, financially feasible. Do you remember? Who said here? Ind AS 113. So fair value, the standard is for assets and liabilities. You see, we have fair value for everything. We have fair value for contract also. I take a contract with Taj Bengal. that every day I'll be supplying 1000 kgs of onion. Financially possible? Yes. Available in Sialda, I have my own transport, I have money, I can buy. Things are to be delivered by 7 o'clock in the morning, okay. The market opens at 2 o'clock in the morning, so I'll buy those, no problem. Okay? Legally permissible, yes, I have this trade license. Okay, they are a very good paymaster, they can also buy on their own. It's a limited company. It is permissible. I have that transport, that courier with a genuine security. Same thing, the third question arises, it is financially feasible. First thing is, at the outset, if it is not financially feasible, I will definitely not go for this contract. Yes or no? I have sold goods to 100 people and I can make an estimate that 5 of them will not pay. I know, I make an estimate, 4 to 5 of them will not pay. What I don't know, who are those 4 or 5 non-paying culprits? If I know that if I sell goods to you and you will not pay, shall I sell? No. So something, every contract when there is some fair value, and are all followed, abided by. Physically possible, yes. If it is yes, then go for the next one. Legally permissible, yes. Third, if these two yes, then go for the third. So if I say yes, what is the price I am quoting? I am quoting 20 rupees per kg, they will pay. They were good, very good paymaster. At the end of the month, they clear their dues. What is my purchasing price? It varies from 14 to 15 rupees. First class, physically, I mean financially feasible. So this is called executory contract. That is, my expected benefits are more than my anticipated costs. So I go for it. What happens? This is the agreement for 1 year only. In December, the price of the onion become 80 rupees a kg. The contract becomes onerous for me. I cannot earn profit. I am to buy from the market 80 rupees a kg and I have to sell at 20 rupees a kg. If I don't do that, what I lose? That security deposit. Yes or no?
Yes.
That security deposit. One thing to remember, we always understand impairment of an asset. It may have two things. That asset itself is impaired. That means what? That asset has either become obsolete, can't use, or it has become inadequate. Petrol taxis I can run, but I cannot run profitably. I can still use typewriter, but profitably I cannot. So that thing becomes inadequate. So if I just stop supplying that, so I am to make one trade-off between these two. For coming 4 months remaining, I have to buy 80 rupees. I do not know what is the price, how much loss I will suffer, and if I stop this, how am I doing? So just imagine inventory. There is, I bought for this 80 rupees and its selling price is only, so there is no question of net reserve fair value. This onerous contract, just one hint is given, entire thing will be covered in Ind AS 37. I need to create a provision for that, I create to defer taxes also. So onerous contract is not executory contract. Inventory, I have to buy at 80 rupees. Maybe in my stock at rupees, I have to sell this at this price only. Next.